Ben Reppond. Welcome to my YouTube broadcast. Today is May 29th, 2024. Yesterday I did the broadcast and I featured Henrik Zeberg, a macroeconomist from Copenhagen, being interviewed by James Conner from Toronto. And the thesis of his presentation was, so I agree with, and it said that he believes the market is going up, the S&P is going up to, he believes, above 6,000. He even used the word 6,100 and 6,200. I don't know if it's that high, but let's just say in excess of 6,000. After it does that, he believes we are in for a decline that will go for a while. I don't know how deep that is, he doesn't say, but certainly beginning sometime later on in the year. It sounds like well into 2025. So I just wanted to pass that on. If you want to watch the video, you can. But I thought that was, he gives some reasons for it. Unemployment and consumer being tapped out based on interest rates and payments, debt, etc. Let's go on to the dashboards. I want to cover that. And this week, this is through last Friday, the 24th of May, you can see we're still, it was a negative week primarily in the markets. The NASDAQ 100 was positive. All other of the indexes were negative, including the 20-year government bond, but not a lot. So when you still look at to the right, you see the green dots and red dots. The green dots mean, going from left to right, that the particular index or ETF is above its 20, 50, 100, and 200-day moving average. And in only 3 instances are there red dots. So the weakest last week was definitely the Dow, and that was negative enough to push it below its at least the 20-day moving average. And of course the long-term government bond is negative on its 100 and 200-day. But everything else still positive above those moving averages. So I call that just noise. It's not, in my opinion, not the beginning of a down market. Not yet. The sectors, the S&P 500 is broken down into its 11 major sectors, industry sectors, and those start from top to bottom. Technology, financials, industrials, etc., go all the way down. Now you can see, now keep in mind what I just said about the major indexes. In the left are all of the 11 sectors in a yellow box. All 11 except one. So 10 out of 11 were negative last week. The most negative was energy and then telecommunication and real estate, quite negative. And on a year-to-date basis, real estate, telecommunication, and consumer discretionary, interestingly, are negative year-to-date. The others are positive. When you look to the right, the green dots and red dots above their 20, 50, 100, 200-day moving averages, you can see that there were 12 that were below their moving averages. So that's 12 out of 42. Or it's 12 out of 44, bringing it down to 32 were positive. That compares to 42 the previous week. So previous week was more positive, and this pulled it down a ways. But again, only in mostly in certain sectors. Okay, S&P 500. In a 24-month chart, you can see for about 19 months out of 24 that the S&P 500 has been going up from left to right, marked by the black arrow. And you can see this last week was at the very top, at the very far right top, you can see that it kind of flattened out a little bit. And so, but it definitely has been in an upward trajectory, with the exception of mostly in the month of April. When I take this and break it down into candlestick chart and compress it into a 9-month chart, then you can see this is how it looks from the month of October to present. So this would give us about a 7-month view. So we had a longer view last time, but so for the last 7 months, just like for the last 19 months, it's still in an upward trajectory. The candlestick at the very far right is kind of a cross-looking. That means that it went up above that and it went down below that, but it started and ended about where that cross point is to the right. So still a very positive market and well above its 20-period moving average. This is an interesting chart because here I show the relative strength of growth to value. If it goes up, that favors growth stocks. If it goes down, it favors value stocks. It, again, since the beginning of 2023, mostly has been on an upward trajectory favoring growth stocks. The exception was, you see, kind of toward a little bit to the right of center, that decline, and that was not necessarily a decline in the market per se, but it was a decline in the value being so much more in favor for the entire fourth quarter. Mostly the entire fourth quarter, value was in favor over growth. Other than that, it's been moving up. Then you get to the very far right of the chart. This is what's interesting. Then it spikes up at the very end. So what happened last week was that growth way overtook value. So growth was very in favor, and that probably is tied to AI. The big tech companies that are involved in AI, and but it definitely pushed up growth over value. But when you look at value, a lot of the market, the stock market, is value, and so when you look at that, you go, the market did not participate. The broad market did not participate as much in that as did the large tech companies. Okay, large cap versus small cap. Large cap meaning the 500 largest companies compared to the Russell 2000 small cap index. Again, large cap may be driven by AI again, pushed up higher than value, or excuse me, higher than small cap. The long-term government bond, at the very far right, you can see 2 or 3 weeks where it has moved up a little bit, but it still is in a long-term trajectory of going down, which means that interest rates and bond yields are going up, at least for now, while the price of bonds themselves are declining. The US dollar had a little bit of a pullback. You can see that at the far right, but still is in a long-term trajectory and well above its 20-period moving average over this 3.5-year period of time. Gold, as you can see on the very far right of the chart, had a pullback. That decline was a pullback, and I'll give you the detail on that later. But long-term, since late 2022, has been in an upward trajectory. Silver, same thing. It has had a very good run up, and it had a little bit of a pullback. That didn't surprise anyone. But boy, for the last few months, it has really been on a tear. And I was looking this morning as I'm recording this, right now, it's moving back up again. So silver positive, gold positive, but silver even more so. This is the relative strength chart. You can see to the far right how much silver, and this is due mostly to the previous week, silver has been outpacing gold, going up, but going up faster than gold. But of course, you can see for the year and a half before that, it's gone up and down, and mostly down during that period of time. But boy, it's beginning to make up for it, and people are buying silver and gold, and especially silver at this point. Bitcoin continues to rise. You can see that at the far right of the chart, and is in a long-term upward trajectory. Volatility dropped all the way, the volatility index, the VIX index, dropped all the way down below 12, down to 1193 as of last Friday. That is a lot. And this is not far away from its all-time low. So when volatility is low, this is good for equities. So you've seen the S&P 500 and other indexes that are going up, and conversely, the volatility index is coming down. Asbury Research, even though it was a negative week, it was not a heavy negative week, but it was a negative week. You can see that all of the indicators at Asbury, the 6 indicators, are all still positive. On the cross-asset relative performance schedule, comparing one asset to another, here's the things that are in favor. Stocks are more favorable than bonds, for sure. Large cap more favorable than small cap. The broad market, the S&P 500, more favorable than the blue chips, the Dow Industrials. Technology more in favor than the broad market. Growth more in favor than value, for sure, we saw that. And the U.S. more in favor than the developed markets, mostly Japan and Europe. When we look at the U.S. versus the world, because of the things I just said, it puts the U.S. in kind of in the driver's seat as being more dominant than most other countries. The exceptions being, for the last week, month, and quarter, the exceptions being Taiwan and India. They outperform the U.S. But U.S., in all 3 time periods, I'll go through these, we're better than Canada, Mexico, France, Japan, South Korea, Thailand, China, and Thailand and the Pacific and Australia. And those are the ones decisive where we're ahead for all 3 time periods. Okay, so I did this. This is again, U.S. is stronger than a lot of countries, a lot of European countries, etc. But again, I've been showing Switzerland as a surrogate for European countries. And you can see from May of last year to present, so it's about a year period of time, the direction. This is the degree to which our market, and I'll just say the market is the S&P 500, is stronger than the broad market in Switzerland. That's quite a move. Gold and silver. You saw on the chart that gold and silver both had a pullback this past week. Gold came down 3.4%, silver came down 3.6% from the previous Friday, bringing gold's spot price down to $23.35, silver down to $30.36. But as I said, I looked this morning and both of these are back up. The gold-silver ratio is 77 to 1, still has a ways to go, but right now silver is in favor as a better buy based on historical patterns of that ratio. A monster box of silver bullion is 500 ounces of pure silver, 0.999% pure silver, and a monster box is $15,765. So if you're interested in buying some, that's the ticket. And that includes $1.17 over spot. Now these prices are for my son, the price he sells them for, but you can look at your local retailer. He will tell you, and I tell you, don't buy over the internet, buy brick and mortar, and buy local if you can. But he provides these to me just to give you a benchmark on what the prices that he uses. So for a box of 500, that means that you're paying, including markup, you're paying $31.53 per round. And for a tube of 20, you're paying $32.03, so 50 cents more per round when you get it in the smaller quantities. Gold is in favor. From everything I read, even though it's up quite a bit, there's a lot of people who are saying that they believe it's going to go higher, that we are in for a period of escalating gold and silver prices. So I've said this before, I keep saying it, I like it not as an investment, I like it as a hedge against the decline or even the collapse of the dollar. So if we get to a barter system, which I hope we don't, but if you need something besides paper dollars to buy something with, you're going to need something probably of intrinsic value. At least that has been the case throughout all of history. So, and I think gold and silver fit that category of having intrinsic value. Now, there are people who will argue that Bitcoin has intrinsic value. You know, I look at it a little differently. I think, you know, something is tangible, that has been tangible and of intrinsic value for over 5,000 years, like gold and silver, I say that has more appeal to me. But I don't disparage people who believe that Bitcoin would fit that bill as well. Even though it's more intangible, they believe because of the cost of mining and demand that it would qualify as well. But either way, when you come down to a piece of paper, $1 or 20 or 100 or whatever, a piece of paper, at some point, at least throughout all of history, where there have been paper currencies or something similar to paper currencies going back centuries, that it has always been replaced with something of intrinsic value, namely gold and silver. So, thank you for watching. If you have questions or comments, leave them in the comment section below.